Hi everyone, welcome to Tutorials on the Go. I am Edmond Dramna, the lead consultant for DW Consult, and I'm going to be your facilitator for today's lecture. So did you know that accounting is the language of business propounded by Warren Buffett? In this lecture, we are going to talk about accounting. We'll first do an introduction to accounting, discuss the types of businesses that require the services of accounting, move on to talk about the uses of accounting information, then finally dissect into the two main types of accounting we have. Stay tuned, it's going to be fun. Let's move straight to talk about the introduction to accounting. So what is accounting? It is the recording, classifying, summarizing, and interpreting information. We'll look at the various elements into little details. Recording. This is also known as bookkeeping. It is the basic phase of accounting, where transactions are recorded into its appropriate books with the help of relevant documentation such as invoices, receipts, purchase orders, credit and debit notes, etc. Classifying. Now this involves sorting and grouping similar items under a designated name. That is, after you have recorded the various transactions, similar items are grouped into one heading. So various electricity charges are put under an electricity account. Various travel expenditures are put under a travel account. Summarizing involves presenting the classified information into reports such as the profit and loss, the balance sheet, cash flow statement over a month, a quarter, that is 3 months, or a year, depending on who is requesting for the information. Then move on to talk about interpreting, which concerns itself with analyzing the statement for users to make meaningful judgment out of it. We are going to talk about the uses of financial statement later on, so don't worry if you don't know them. Let's talk about the types of businesses that require accounting in their operations. The first one is sole proprietorship. Now, the sole proprietorship here is owned and run by an individual. It means that all the assets, the money, the equipment are provided or to be provided by one person. Now, there is no legal distinction between the owner and the business. It means that the owner is the same as the business and vice versa. The owner gets to settle the losses of the business alone. Then, in settling the losses of the business, their private property or investment are not protected. It means that they can be called upon to settle the loss if it is more than what was contributed or the money is available to settle. Let's talk about partnership. So partnership is run and owned by more than a person. So two or more people coming together to form and run a business. So the two or more people are entitled to the share of the business based on the amount they contribute. Right? So partners are also liable for the losses of the business, but here it is up to their ownership stake. So if somebody owns 30% of the business, he or she is entitled to pay 30% of the losses available. Also, their private investment or assets are also not protected from settling their quota of the losses. Now, the third and final type of company we'll be talking today is the limited liability company. Here, the business is distinct from the owners. So, the business can enter into contracts, have bank account details, tax identification number dedicated to it, and the owners also can have these separately. Now, ownership here is by shares. Any amount you contribute towards owning the company or owning a part of the company will be into buying shares. So the owners of a limited liability company are called shareholders. Now here, their private property are protected from being called upon to settle losses of the company when such happens. Let's talk about the users of financial information. So the users of financial information are those who have interest in the operations of the business. They are categorized into internal and external users. Let's talk about the internal users. The first of them is management. Here, they will want to know whether the tactics that they employed in running the business has yielded fruits. The next one are the shareholders. They want to make an informed decision or judge on the returns on their investment. They also want to decide on the performance of the management, whether to keep them or replace them. Mind you, they employ management to run the business on their behalf. Employees, they want to know the financial information to be able to negotiate for further salary increments. They will also need the financial information to determine whether the business can continue in the foreseeable future, securing their employment. Let's move on to talk about the external users. External users, the first one we'll talk about are the customers. So here, customers will want to know whether they are assured of a steady supply of their inventory. Potential investments will want to judge whether the business is worthwhile to invest in. Creditors and suppliers will want to determine whether the debt or the goods advanced to the business will be paid, or their debt will be paid when they fall due, and also to determine whether to grant further credit or review the already given credit to the business. Lenders will want to know whether loans given or to be given will be paid on time. Government also will want to know whether tax due them is what is supposed to be paid or is what is being accrued for. Then competitors will want to gauge their performance to this business and make informed decisions. Now, the main thing to note is that balance sheet, profit and loss, cash flow statements are available to all users of financial information. However, there are certain information that will not be open to all users. For example, details of the financial information can be requested by management and shareholders, but it will be out of reach to customers, competitors. So this three statements will be open to all, but management might have access to other details or other information in the business. Now, financial accounting and management accounting, what are their differences? Now, financial accounting is meant to serve internal and external users, but that of management accounting, that is their reports, are reserved only for internal users, especially management. The main focus of financial accounting is to gather information on activities just to prepare financial statements. Now, management accounting concerns itself with why those activities came to place and the effects on the business's performance. Now, financial accounting's information is meant to gather past activities, whilst information in management accounting is meant for the future. So financial accounting focuses on the entire business. Management accounting focuses on individual activities, units, departments, products making up the business. This brings us to the end of today's lecture. Feel free to drop your comments in the section on our social media handles: Facebook, Twitter, YouTube, and Instagram, and I'll be very glad to address it. Join us again next time when we do make another video available. Thank you and stay blessed.